Hello. In this presentation, I'm going to look at the area of business valuations, including an overview of the various methods that can potentially be adopted. Specifically, this presentation will cover introduction and rationale, an overview of valuations, share-based approaches and the EMH, asset-based approaches, dividend-based approaches, earnings-based approaches and cash flow-based approaches. Let's look at each of these in turn. Introduction and rationale. As is discussed in the Financial Management Objectives presentation, one of the decisions that finance managers have to make is the investment decision. As is also covered, one aspect of this is the decision to invest in other companies, i.e. the acquisition of other companies. If this is to happen, the company will need to decide how much the target company is worth, i.e. how much it should pay. This is, however, only one reason why a business valuation may be required. A company may wish to value its own business either because it is the subject of a takeover bid or because they wish to float the company on a stock exchange. An overview of valuations. In many ways, there is no such thing as the correct value of a company. Indeed, the only true value is the value that two parties agree on for the transfer of ownership from one party to another. Having said that, as discussed in the introduction above, both companies will need to form an opinion as to the amounts they are willing to pay or accept in order that they can negotiate to a final price. In simple terms, the seller will need to identify the minimum price they are willing to accept and the buyer the maximum they are willing to pay. Assuming the maximum is higher than the minimum, certainly not guaranteed, then somewhere in between the two is a figure at which both parties would be willing to trade. The exact figure within the range will be determined by the relative bargaining power of the two parties. How much the seller wants to sell, how much the buyer wants to buy, etc. We will now look at some of the approaches that the parties might adopt in arriving at a range of valuations that they can negotiate within. Share-based approaches and the EMH. Many companies already have a value in that they have a share price. The company value can then be derived by multiplying the share price by the number of shares in issue. In order for this to be a valid approach, however, the company must be listed, i.e. it must have a share price. The shares must be regularly traded, i.e. the share price must be current. And the market must operate efficiently, i.e. the share price must be adjusted quickly and accurately in the light of new information. Market efficiency is concerned with how quickly and accurately a market interprets available information and updates share prices accordingly. One interpretation of this final aspect is provided by the efficient market hypothesis, or EMH. This states that markets operate at one of three levels of efficiency. A weak form efficient market will only consider things that have actually happened, including past share purchases. It will not reflect latest information with regard to expected future performance. As such, the quoted share prices cannot be guaranteed as up to date. A semi-strong form efficient market will include all historic information as described above, however, will also include all information that is in the public domain. A strong form efficient market will include all of the above, however, In addition, it will reflect information not in the public domain, i.e. that held privately by directors. It is difficult to see how this can be achieved in practice. An individual investor can outperform the market if they are able to operate at a higher level of efficiency than the market. Accordingly, a weak form market will be beaten by an investor that operates in a semi-strong way. In the same way, a semi-strong market would be beaten by a strong investor. However, taking advantage of private information, known as insider dealing or insider trading, is illegal. Asset-based approaches. A company can be valued as the value of its net assets, i.e. assets minus liabilities. The simplest way to assess this is based on book values. However, these do not necessarily reflect the amount that would be achieved in a sale. As such, a realizable value, the amount generated from a sale of the assets, will provide a more accurate valuation, albeit it is more difficult to assess. Limitations of the asset-based approach are: it ignores the value of intangible assets, and it ignores the fact that the company can be used to produce future profits and cash. The asset-based approach is likely to produce a valuation towards the bottom of the negotiation range, and is only really valid when liquidation is the only other option for the seller. Dividend-based approach. The dividend-based approach values a company as the present value of the future dividend stream that would be earned if the target company continued under current ownership. Effectively, it is offering equity shareholders a lump sum now that equates to the value of dividends that are expected to be received in the future. This approach is most appropriate where a minority shareholding is being valued, as it does not include any premium for control. For example, if a 10% shareholding is worth £10 million, you would expect to pay more than £60 million for a 60% shareholding due to the control that would be acquired. The value can be calculated as the dividend in 1 year's time divided by the cost of equity of the target company shareholders minus the expected dividend growth rate. Weaknesses of this approach are: it is difficult to estimate the dividend growth rate. The model assumes the dividend growth is constant. Not all companies pay dividends, and this model would value such businesses at nil, and the model would produce a negative value for an organisation where the dividend growth rate is higher than the cost of equity. Earnings-based approach. A company can be valued as a multiple of its earnings. Earnings are the profits that are distributable to equity shareholders, and the multiplier is provided by the price earnings or PE ratio. The PE ratio is effectively a measure of confidence that the market has in the company. In other words, it reflects market expectations of growth set against inherent risk levels. The valuation is simply the earnings multiplied by the PE ratio. However, an unlisted company will not have a PE ratio. This can be overcome by using an industry average PE ratio, or better still, using the ratio of a similar company, referred to as a proxy, that is listed. Obviously, the resultant valuation will be limited to the level of similarity that can be achieved between the target and proxy companies. It is also common practice to reduce the proxy company PE to reflect the difference in status. Adjusting downwards by a third is typical. Cash flow based approach. The final approach involves treating the acquisition of a new company in the same way as any other capital purchase, i.e., estimating the present value of relevant cash flows via an NPV. The cash flows should include any benefits from the acquisition known as synergies. For example, it may be the case that the buyer would move the target staff into its own premises and sell off some of the target's property. Allowance should also be made for the replacement of the non-current assets of the target moving forward. In other words, if the buyer acquires the target and distributes all profits to shareholders, over time the assets of the target will start to wear out and need replacing. Finance will be required to achieve this, and the funds that are available to be distributed without jeopardizing this aspect are sometimes referred to as free cash flows. Thank you.
Welcome to F9 Financial Management. In this section, I will go over the valuation of debt and other financial assets. So, if we wanted to get debt financing, we would approach a bank and get a loan, or at least attempt to secure a loan. This is the same for small businesses. But large businesses and organisations can issue debt. You've already learnt about debt that can be issued and traded on the financial markets. But how does the company value this debt, and how does the investor put a value on this debt that they invest in? Traded debt takes on many forms, and they are called loan notes, loan stock, debentures, and bonds. They are all traded debt, and investors assess their value based on their expected return. In this section, I will cover the valuation methods to value irredeemable debt, redeemable debt, convertible debt, and preference shares. What is the market value based on? As I said, the value of traded debt and any asset, when you think about it, is based on the expected returns of the asset. Debt is traded in nominal amounts of $100 and offers an annual coupon rate. Its value is dictated by its expected returns. The expected future returns are then discounted to the present value based on investors' expected rate of return. What affects expected rate of returns? As I have said before in earlier videos, the risk-free rate of return affects the expected rate of return. This will set the boundary for what is the minimum return investors expect. If banks offered a 10% return for monies held on deposit, then investors would expect to receive more than 10% return for their investment. If the next year the banks lowered their return, only offering a 4% return, this would mean that investors would require a lower rate of return for their investment, and the value of debt assets would increase. The current value of debt is determined by the current expected returns of that asset. So, for example, an investor expects their investment to be worth $1,000 in 5 years' time, and the current cost of finance is 10%. We use the discount factor at 10%, which is the cost of finance or the investor's expected rate of return, and get the current value of the investment. It is $620.92 if you calculated it. Now, between today and 5 years, a lot can happen, completely changing the value of this return. But today, the expected return of this asset, which is expected to be $1,000, so this is what we base the value on. So, how do we value irredeemable debt? Let's start with what it is. It is debt that has no fixed repayment date. Instead, the company pays interest on the debt annually. The interest rate is also referred to as the coupon rate, which is paid in perpetuity. So let's look at an example. Longevity Incorporated has 6% irredeemable debt in issue. Investors required a return of 9%. What is the value of the debt? We value this debt as follows. We assume $100 nominal value at 6%. We know that $6 are being paid to investors annually. We also know that this is irredeemable, so technically this will be paid forever. What does that tell us? It is paid in perpetuity, so we must discount it on this basis. How do we get the discount factor of a perpetuity? 1 divided by OR, where OR is the discount rate. It is the expected market return. So here 1 is divided by 0.09, which is the expected market return, 9%. So what is the value of this irredeemable debt? $6 multiplied by 1 divided by 0.09, which is $67. Next, how do we value redeemable debt? Redeemable debt is repayable on a certain date. It is issued and has an interest rate attached to it. Sometimes it is repayable at a premium. Let's look at how it is valued here. XYZ Incorporated has 5% debt that is redeemable to investors in 5 years. The investor's expected rate of return is 6%. Knowing what you know from valuing irredeemable debt, and that its value is based on the expected returns, pause this video and calculate the value of XYZ Incorporated's debt now. Have you done it? Okay, so we assume that the nominal value is $100, so the question does not mention a premium. So at the end of 5 years, the $100 will be repaid to investors and they will receive 5% interest annually. So we also know that investors expect a 6% return for their investment. So let's put this information together and calculate the present value of the future returns. In this table, you can see the annual cash flows. The investors receive $5 a year, which we get from the coupon rate. In year 5, they also receive back their initial investment of $100. These cash flows are discounted at 6%, which is the investor's expected rate of return. Total, the present values, and the market value is $95.79. This should look familiar to you. It is very similar to valuing projects. Now, what if XYZ Incorporated paid a premium of 20% after 5 years? Assuming everything else remains the same, I want you to pause this video and calculate this. Done it? So let's start with calculating the premium that they will pay. It is 20% of the nominal value. So that is $100 multiply by 20%, which is $20. This means in year 5, the investor will receive $120. You can see the calculations on this table. Now, the investment is worth $110.74 since the premium increases the expected return of the asset. Its value increases. Because as you know, the value of the asset is based on its expected returns. Now, let's look at convertible debt. What is it? This is initially debt. However, on the repayment date, the investor can choose to convert their debt into a fixed amount of equity. So, for example, Indigo Incorporated has 5% debentures that are convertible in 5 years' time into 30 shares in the company. The current share price is $2, and this is expected to increase to $5.50 in 5 years' time. Investors expect an 8% return per annum. So, what is the market value of these debentures? First, we must find the future expected returns. In 5 years, investors can choose to receive their initial investment of $100 back, or they can receive 30 shares which are expected to be worth $165 in total. Well, looking at this, what would you choose? I hope it's converting the debt to shares. It's worth $65 more. Remember, they don't need to keep them. They can sell them on the stock market and receive $65 cash more than their initial investment. Pause the video here and calculate the value of this convertible debt. Have you done it? So, in the table you can see the annual interest or coupon rate of 5%, which is $5. And then in year 5, the expected value of the shares is calculated, and the value of the investment is worth. Now, I know you are thinking that the share prices could just as easily fall, and you're right. The valuation of the convertible debt is only based on the expected return at the time, and as the expected return changes, so does its value. So an investor may ask, or an examiner may ask you, what is the floor value of this investment? How low can it go? So let's look at the example again. What if the share prices do not go up in value? So the investor will have the option of their $100 initial investment, or $30 worth $2, so $60 in total. Now we calculate the floor valuation as follows. See the table. It is $88. The floor valuation is how low this investment can go, and in this case, the investors will get back their initial investment of $100. Now, let's look at valuing preference shares. These are an interesting mix of debt and equity, and you have heard a lot about them. But how are they valued? Like debt, there is redeemable and irredeemable preference shares. They pay a fixed interest rate or coupon rate, which is paid annually. Let's look at an example. Preferred Incorporated has 10% preference share capital, and investors' expected return is 5%. Pause the video and calculate this. Have you done it? Was it familiar? Since the question didn't mention anything about redemption date, I am going to assume that there is none, and that 10% or $10 will be paid into perpetuity. So what is its value? Like irredeemable debt, we find its value as follows. So it's $10 multiplied by 1, which is divided by 0.05. That's the 5%, which is the investor's expected return. And that equals $200. Now, what if the company sold these preference shares that were redeemable after 5 years? How would you calculate that? Pause and give it a go. Have you done it? Okay, let's look. So it is just like the redeemable debt. The annual interest payable is 10%, which is $10 per year, discounted, and at the end of 5 years, investors receive back their initial investment. Now, just to finish off, I want to discuss the interest yield and the redemption yield. The interest yield is defined as the coupon rate divided by the market value at 100%. So ABC Incorporated has 5% debentures trading at $15. The interest yield is $5. Redemption yield. This is the overall return per annum. The interest plus any gain on repayment. Thank you.